Turning risk into consistent gains is the biggest challenge every trader faces in the market routine, where seconds define success or loss. In a breakout with intense volume, wide candles, and high volatility, the pulse races, breathing shortens, and the eyes lock onto the screen, looking for the exact moment to enter. The tension in the body is real because a wrong decision can be costly. At other times, the market sends confusing signals with accumulated pressure and false breakouts, creating doubt and insecurity that hinder risk management and position sizing. This difficulty arises from the lack of a simple and objective rule that turns risk into a predictable tool, making it an ally, not an enemy. Many lose control by fragmenting strategies and opening too many positions, compromising results in scalping, day trading, or swing trading. The secret lies in controlling this risk as part of the plan, calibrating entry timing, adjusting position size, and respecting the risk versus reward ratio defined by Rule #1. Without this discipline, overtrading emerges and profits vanish. In this video, you'll understand how to master this discipline practically, turning fear and uncertainty into predictability and consistency, even when the market is volatile and movements unpredictable. This method is what separates the amateur trader from the professional. Subscribe now to receive rules that can change your results in risk and consistent gain, and access advanced content that simply isn't shared anywhere else. Stay until the end to discover the ultimate checklist that differentiates amateur traders from professionals. Risk is the variable that shapes every decision a trader makes and defines the fate of the capital at stake. The complexity lies not only in understanding the concept but also in how this exposure becomes tangible in the operational environment. During a breakout, volume explodes, candles widen, and volatility increases rapidly. These factors heighten opportunity, but also raise the cost of the trade. The spread expands, making entry and exit more difficult, and slippage increases, requiring precise timing. The trader physically feels this pressure. The pulse races, breathing accelerates and becomes shallow. The gaze locks onto the screen, searching for clear patterns amid the noise of prices, while muscle tension signals that the body is reacting to the anticipation of movement. This physiological response is not secondary. It directly impacts the quality of execution and the ability to maintain discipline under pressure. In each trading style, the nature of risk changes, requiring adaptation. In scalping, risk is intense and immediate, with quick entries and exits that demand confidence in the speed of decision-making to minimize losses. Day trading faces a different dynamic, although there is a larger window to adjust positions. Daily volatility and the abundance of false signals amplify the challenges, making it essential to filter out market noise. In swing trading, the time risk is higher. External events can drastically alter a position, requiring conservative sizing and strict stop control. Controlling risk, therefore, is understanding the context and knowing how the market behaves in different phases of the trading day and across various styles. This does not eliminate risk, but it allows it to be interpreted with objective, clear rules, transforming it into a tool for predictable profit. A trader who internalizes this perspective can neutralize anxiety, keeping execution focused on what truly matters, the balance between risk and reward. Without this solid foundation, emotional flow and impulsive decisions undermine results, even when technical analysis and setup seem correct in theory. The cornerstone of consistency lies in a single rule that guides all risk decisions, respecting the maximum acceptable risk for each trade, based on the account size and the trader's profile. This Rule #1 is the non-negotiable parameter that keeps the trade within the comfort zone, preventing losses that could jeopardize continuity. Without this clear reference, the trader becomes vulnerable to impulsive decisions, opening larger positions than they should in search of a quick recovery, which usually accelerates the loss. Controlling entry timing is an integral part of this rule. Entering too early may expose the trade to a false breakout. Entering too late reduces the potential risk versus reward. The perfect timing lies in the balance between acting before the market reacts and validating that the movement is not a false signal. To achieve this, the trader needs to interpret volume, candle strength, and spread behavior in real time, filtering out noise and focusing on the setup that follows Rule #1. Position sizing should be calibrated not only to protect capital, but also to maximize potential return within acceptable risk. This means adjusting the number of contracts or lots based on current volatility, and the size of the stop, always prioritizing account preservation over immediate profit. Strict rules for limiting daily and weekly risk are also part of the protocol to prevent emotional and financial wear and tear. Finally, it is essential to follow a clear protocol that prevents overtrading. The anxiety generated by volatility may push traders into multiple operations outside of the plan, but Rule #1 creates a barrier of caution, ensuring that only trades aligned with the defined risk criteria are executed. This discipline protects capital and builds the foundation for consistent long-term gains. Each trading style requires specific adaptations in risk management to ensure that Rule #1 functions effectively. In scalping, risk is controlled in fractions of a second, with quick entries and exits. It is crucial to maintain a conservative position sizing because the spread widening and high volatility can quickly erode capital. Timing must be calibrated to capture the initial movements of a breakout, avoiding prolonged exposure. In day trading, the challenge is greater, as the market offers multiple signals throughout the day, increasing the risk of overtrading. Here, the focus should be on analyzing the volume flow during the session, identifying true breakouts, and avoiding false signals that lead to repeated losses. Position sizing needs to adjust according to intraday volatility, and the discipline of maintaining the risk versus reward ratio is essential to avoid cumulative losses. For swing trading, risk management extends to a longer horizon, where unexpected events can quickly reverse a position. This requires wider stops and a proportional reduction in position size to preserve the account against this higher exposure. Profit expectations should accommodate the greater volatility of these periods, and constant assessment of both macro and micro contexts is necessary to determine whether the trade is still valid. Understanding these nuances allows for the practical and effective application of Rule #1, respecting the unique characteristics of each approach. Maintaining discipline in risk management in these different contexts avoids emotional decisions and consolidates consistent gains with trades aligned to real risk. Exiting a trade is just as crucial as entering it to ensure that controlled risk turns into actual profit. A disciplined exit means respecting the stops defined by Rule #1, even in the face of the temptation to extend the trade to seek larger profits. Missing the timing of the exit can undo all the work done in managing initial risk, increasing drawdown and jeopardizing capital. Therefore, establishing objective criteria for taking profits and limiting losses is essential in the trader's routine. Emotional control is directly linked to this discipline. Under pressure, the trader often breathes irregularly, with a tense body and racing thoughts, which distorts the perception of market movements. Training breathing and adopting a posture that promotes relaxation helps reduce anxiety, stabilizing focus on technical decisions. Additionally, it is important to recognize signs of fatigue and stress, especially in long trades or intense scalping and day trading sessions. In these situations, taking breaks to rest and reviewing the trading plan before re-entering can help avoid impulsive decisions or mistakes driven by exhaustion. Exit management also includes the dynamic evaluation of risk during the trade, adjusting stops to protect gains and limit losses as the trade progresses. This requires patience and self-control, which are essential for turning risk into sustainable profit over the long term. The operational checklist should begin with a rigorous definition of the maximum risk allowed per trade, taking into account the account size and the trader's profile. Next, position sizing must be calibrated, adjusting the number of contracts or lots based on market volatility and the defined stop. The entry timing should be validated to ensure that the calculated risk aligns with the identified setup. This prevents entries that deviate from the standard and compromise the risk versus reward ratio. A critical point is respecting stops without impulsive changes or fear, thus maintaining discipline that prevents larger losses. It is also important to monitor the total number of trades to avoid overtrading, which undermines the chances of success even when strategies are correct. Constant practice with trade replays is an invaluable tool for improving timing and reinforcing learning. One must also focus on physical control during trades, working on posture, breathing, and muscle relaxation to mitigate emotional impact. Keeping detailed records of entries, exits, losses, and gains, along with the emotional factors involved, creates a solid foundation for self-awareness and progressive adjustments. Following this checklist daily transforms risk into a controlled and predictable element, creating the mindset and execution that separate the amateur trader from the consistently professional one.